Dorothy is 71 years old. She was a school librarian for 33 years in Ohio. She retired in 2022, and she has been filing her own taxes every April since 1984. She is careful, organized, and honest. She has never cheated on her taxes in her life. She is also overpaying the IRS by approximately $3,400 every single year. Not because she lied, not because she made a math error, not because she used the wrong form, not because she was careless. Dorothy knows her Social Security is taxable at the federal level because her income is above the threshold. She knows her IRA withdrawals are ordinary income. She files Form 1040 every year, and she does it correctly. The overpayment is not in the errors on her return. It is in the deductions and strategies that do not appear on her return at all. They are not there because Dorothy does not know they exist, and the IRS is not going to tell her. Not because she lied, not because she made a math error, not because she missed a form, but because the tax code contains multiple deductions and strategies that exist specifically for retirees, that Dorothy qualifies for, that her tax software did not flag, and that nobody told her about. This video is not about fraud. It is not about cheating. It is not about elaborate tax shelters for the wealthy. It is about the legal deductions and strategies that are sitting in plain sight inside the tax code, designed for people exactly like Dorothy, that most retirees never claim because they simply did not know they existed. I am going to walk you through the 5 most common ways retirees overpay the IRS every year. Each one is legal. Each one is available to most retirees. And each one is something that the IRS will never call you to tell you about, because the IRS does not volunteer money back. It keeps what you give it. This video is for educational purposes only and is not tax or financial advice. Consult a qualified tax professional before making any decisions about your specific situation. My name is Kevin Retires. Every week I break down the tax rules, the financial traps, and the strategies that protect retirees from the things nobody else is explaining. If that sounds like something you need, hit the subscribe button right now and turn on notifications so you never miss a video. Let me start with the one that costs retirees the most money and that almost nobody over 65 is claiming correctly. The first way retirees overpay is by not claiming every deduction they are entitled to as a senior. Most retirees know about the standard deduction. What many do not know is that they are entitled to a larger standard deduction than younger taxpayers, and that starting with the 2025 tax year, a brand new deduction was added on top of it. Here's the complete picture for 2026. The base standard deduction for a single filer is $16,100. For married filing jointly, it is $32,200. Those are the numbers most people see in their tax software. But if you're 65 or older, you get an additional deduction on top of the base. For single filers and heads of household who are 65 or older, that additional deduction is $2,050. For married couples filing jointly, each spouse who is 65 or older adds $1,650 to the standard deduction. So a married couple where both spouses are over 65 has a standard deduction of $32,200 plus $3,300, totaling $35,500 before the new senior bonus is even considered. And then there is the new senior bonus deduction. Under the One Big Beautiful Bill Act, signed into law on July 4th of 2025, taxpayers who are 65 or older can claim an additional $6,000 per person for tax years 2025 through 2028. For a married couple where both spouses qualify, that is $12,000 added on top of everything else. The bonus phases out for single filers with modified adjusted gross income above $75,000 and for joint filers above $150,000. This is confirmed by IRS Tax Tip 2026-14, issued February 19th of 2026. Before I add this up for Dorothy, let me be clear about why the stacking of these 3 layers matters so much. The base standard deduction reduces your taxable income dollar for dollar. The additional senior deduction reduces it further. The new senior bonus reduces it further still. For a married couple where both spouses are over 65 and qualify for all 3 layers, the total standard deduction for 2026 is $32,200 in base deduction, plus $3,300 in additional senior deductions, plus $12,000 in senior bonus, totaling $47,500. A couple with $47,500 in deductions may owe no federal income tax at all, depending on their gross income. A couple whose tax software only applies the $32,200 base deduction may be paying tax on $15,300 of income that should have been offset. At a 12% tax bracket, that is over $1,800 in unnecessary tax paid in a single year. Let me add this up for Dorothy. She is single, 65 or older. Her standard deduction is $16,100. Her additional senior deduction is $2,050. Her new senior bonus deduction is $6,000. Her total deduction before any other adjustments is $24,150. If Dorothy's tax software is only applying the $16,100 standard deduction and missing the 2 additional senior layers, she is overpaying on up to $8,050 of income that should have been deducted. At her tax bracket, that is a real dollar overpayment every single year. The fix is to verify that your tax return shows all 3 layers of deduction if you are 65 or older and within the income limits. The second way retirees overpay is by not using the qualified charitable distribution. If you are 70 and a half or older and you give money to your church, your food bank, your hospital, your alma mater, or any qualified 501c3 charity, and you are taking money out of a traditional IRA to fund your living expenses, you may be making 2 separate mistakes at the same time. You're taking a taxable IRA distribution and including it in your income, and then you are donating money from that after-tax income, hoping to get a deduction. The problem is that most retirees take the standard deduction and cannot itemize their charitable contributions anyway. So the donation costs you full income tax on the IRA withdrawal, but gives you nothing back. The QCD does something completely different. Instead of withdrawing from your IRA and then donating, you direct the IRA custodian to send the money directly to the charity. The money never passes through your hands. It never appears in your adjusted gross income. You do not pay income tax on it at all. And if you are subject to required minimum distributions, the QCD counts towards satisfying your RMD for the year. The 2026 limit is $111,000 per person, or $222,000 for a married couple where both spouses have their own IRAs. This is confirmed by Fidelity, Schwab, Kiplinger, and Congress.gov for the 2026 tax year. Here is a concrete example of what this is worth. A retiree who takes a $10,000 IRA withdrawal and then donates $10,000 to charity pays income tax on the $10,000 withdrawal at whatever their marginal rate is, and then gets no deduction because they take the standard deduction. They are down the full tax bill on that $10,000. A retiree who directs a $10,000 QCD from their IRA to the same charity pays 0 income tax on that $10,000. 0. The tax bill disappears entirely on that amount. Over a 10-year retirement, that difference is the cost of a car. Let me add one more dimension to the QCD that is especially important starting in 2026. Under the One Big Beautiful Bill Act, taxpayers who itemize deductions now face a floor of 0.5% of adjusted gross income on charitable contributions. This means that the first portion of your charitable giving, equal to 0.5% of your AGI, is not deductible even if you itemize. For a retiree with an AGI of $80,000, the first $400 of charitable donations provides 0 tax benefit, even on an itemized return. The QCD bypasses this floor entirely because it is an exclusion from income, not a deduction. The money is never included in your income at all. There is no floor. There's no limit related to AGI percentage. Every dollar directed as a QCD is a dollar that was never taxed. In 2026, the QCD has become more powerful relative to a standard cash donation than it has ever been before, and most retirees who could be using it are still writing personal checks instead. The QCD also has a second benefit that very few retirees understand. Keeping money out of your adjusted gross income keeps your combined income lower for Social Security taxation purposes. It keeps your modified adjusted gross income lower for IRMO Medicare premium calculations. And it keeps your income lower for state tax purposes in states that set exemption thresholds based on AGI. One QCD decision can create tax savings in 3 separate systems simultaneously. The third way retirees overpay is by not tracking medical expenses. Unreimbursed medical expenses above 7.5% of your adjusted gross income are deductible if you itemize. For most working-age Americans, medical expenses never come close to that threshold. For many retirees, they do. The expenses that qualify are broader than most people realize. Doctor and hospital bills obviously qualify, but so do Medicare Part B and Part D premiums, Medicare Supplement or Medigap premiums, long-term care insurance premiums up to age-based limits, dental care, hearing aids and batteries, eyeglasses and contact lenses, prescription medications, transportation to medical appointments, which you can calculate at the IRS standard medical mileage rate or track actual costs, home modifications required for medical reasons, such as wheelchair ramps, in-home care for a chronically ill spouse. Before the calculation, let me give you the complete list of expenses that qualify, because this is where most retirees leave money on the table. Medicare Part B premiums qualify. In 2026, the standard Part B premium is $202.90 per month, or $2,434.80 per year per person. A married couple, where both spouses are on Medicare, pays nearly $4,900 in Part B premiums alone every year. That entire amount qualifies as a deductible medical expense if you itemize. Medicare supplement premiums qualify. Medigap plans can run from $100 to $300 or more per month depending on the plan and your age. Medicare Part D premiums qualify. Long-term care insurance premiums qualify up to age-based limits, confirmed in IRS Publication 502. For someone aged 71 or older, the limit is $5,640 per person in 2026. Dental work qualifies. Hearing aids and batteries qualify. Prescription eyeglasses and contact lenses qualify. Prescription drugs qualify, but over-the-counter medications generally do not unless prescribed. Transportation to medical appointments qualifies. Home modifications required for medical reasons, such as grab bars, wheelchair ramps, and stair lifts qualify. In-home care for a chronically ill spouse qualifies. Here is why this matters specifically in retirement. Let us say a married couple has combined adjusted gross income of $60,000. 7.5% of that is $4,500. If their total unreimbursed medical expenses for the year are $12,000, they can deduct $7,500 above the threshold. Whether they should itemize depends on whether their total itemized deductions exceed their standard deduction. But if they have significant medical expenses, significant mortgage interest, or significant charitable contributions in addition, itemizing may produce a lower tax bill than taking the standard deduction. The mistake most retirees make is not tracking medical expenses throughout the year, because they assume they will take the standard deduction anyway. Then at tax time, they cannot itemize because they have no documentation. Tracking costs nothing. Failing to track can cost you the deduction. If this is the first time you're hearing about these strategies and you want to make sure you're not leaving money on the table, hit the like button right now. Share this with any retiree you know who files their own taxes or who uses a preparer who does not specialize in retirement returns. Subscribe and turn on the bell so you never miss a video like this one. The fourth way retirees overpay is by not managing the income that determines how much of their Social Security is taxable. The IRS uses a formula called combined income to determine whether your Social Security benefits are taxable. Combined income is your adjusted gross income plus any tax-exempt interest plus 50% of your Social Security benefits for the year. If your combined income is below $25,000 as a single filer or $32,000 as a married couple filing jointly, none of your Social Security is federally taxable. If your combined income is between $25,000 and $34,000 for single filers, or between $32,000 and $44,000 for married couples, up to 50% of your Social Security may be taxable. If your combined income exceeds $34,000 for single filers, or $44,000 for married couples, up to 85% of your Social Security may be taxable. These thresholds have not been adjusted for inflation since 1983 and 1993. They were set low intentionally so that more retirees would become taxable every year, without Congress having to vote on a rate increase. Here is how retirees overpay on this. Many retirees believe that because they are already above the threshold, nothing can be done. That is wrong. Every dollar you remove from your adjusted gross income reduces your combined income and potentially reduces the percentage of your Social Security that is taxable. The QCD I described in point 2 does exactly this. A retiree who takes a $10,000 IRA withdrawal has $10,000 in AGI. A retiree who directs a $10,000 QCD to charity has $0 added to AGI from that distribution. The second strategy is Roth conversions done strategically in lower income years. Every dollar in a Roth IRA that you convert before you start taking Social Security is a dollar that will never generate a future taxable RMD and will never push your combined income higher. Retirees who do Roth conversions in the years between retirement and age 73, before required minimum distributions begin, can significantly reduce the future income that makes their Social Security taxable. The third strategy involves knowing that municipal bond interest is not as invisible to the IRS as many retirees believe. Tax-exempt interest is added back into the combined income formula. A retiree who holds large amounts of municipal bonds to avoid income tax may still be making more of their Social Security taxable by increasing combined income, even though the bond interest itself is not taxed. Let me put a real dollar amount on this so it is not abstract. Frank is 68 years old, single. His Social Security is $22,000 per year. He withdraws $22,000 from a traditional IRA to cover the rest of his living expenses. His combined income is $22,000 in IRA withdrawals, plus $11,000, which is 50% of his Social Security, totaling $33,000. That is just below the $34,000 threshold, where 85% of Social Security becomes taxable. Currently, about 50% of his Social Security is taxable. Frank also gives $2,000 a year to his church. He does it by writing a personal check. If Frank redirected those $2,000 to a QCD from his IRA instead, his adjusted gross income would drop by $2,000. His combined income would drop from $33,000 to $31,000. He is still in the 50% taxable zone, but less of his Social Security is taxable at that lower combined income. And he has moved further from the $34,000 threshold, where 85% becomes taxable. If Frank's IRA withdrawals were slightly higher, and he was above the 85% threshold, the math would be even more powerful. A QCD of $10,000 from his IRA would reduce his AGI by $10,000, potentially pulling him below the 85% threshold entirely and reducing the taxable portion of his Social Security by thousands of dollars. Managing combined income below the relevant threshold is one of the highest value planning opportunities available to retirees and one of the most consistently missed. There's a sixth area that belongs in this conversation, even though the video is framed around 5, because it affects a significant number of retirees, and the overpayment can be substantial. Many retirees have taxable investment accounts, not just retirement accounts. They hold stocks, mutual funds, ETFs, or other investments that have appreciated over years or decades. Many of these retirees are unaware that they may owe 0% in federal capital gains tax when they sell. The long-term capital gains tax rate of 0% applies to single filers with taxable income below $49,450 in 2026, and to married couples filing jointly with taxable income below $98,900. These thresholds are confirmed by the IRS inflation adjustments for 2026. Here is what this means in practice. A retiree who is living primarily on Social Security and a modest pension may have taxable income well below these thresholds after their deductions. If they sell a stock that is appreciated by $20,000 and they are in the 0% capital gains bracket, they owe nothing on that gain, $0. But here is the specific overpayment trap. Many retirees, or their tax preparers, do not check whether they are in the 0% bracket before selling. They assume that a $20,000 gain is taxable at 15%, calculate a $3,000 tax bill, and either pay it or avoid selling the investment to escape the tax. The actual tax owed in the 0% bracket is nothing. Avoiding the sale costs them the flexibility to rebalance their portfolio or access their gains, and if they do sell and pay the 15% rate without checking their bracket, they have overpaid by $3,000 on a single transaction. The 0% rate also creates strategic opportunities. A retiree in a low-income year, perhaps before Social Security begins or before required minimum distributions start, can deliberately harvest capital gains at 0% tax. They sell appreciated positions, reset the cost basis, and repurchase the same investments. The gain is recognized but taxed at 0. The new cost basis is higher. Future gains from that point are smaller. This is called tax gain harvesting, and it is one of the most underused strategies in retirement planning. There is another capital gains situation specific to retirees that causes significant overpayment. Many retirees hold mutual funds in taxable accounts. Every year, those mutual funds distribute capital gains to shareholders, whether the shareholder sold anything or not. These are called capital gains distributions, and they appear on Form 1099 DIV. A retiree who holds a mutual fund in a taxable account may receive a capital gains distribution of several $1,000s in a year when the fund sold positions internally, even if the retiree never sold a single share. That distribution is taxable income whether or not the retiree needed or used the money. Retirees who hold funds with high portfolio turnover, meaning funds that buy and sell frequently, tend to receive larger capital gains distributions than retirees who hold index funds or ETFs. Switching from actively managed funds with high turnover to low-cost index funds or ETFs in taxable accounts can significantly reduce the annual capital gains distributions that generate taxable income without the retiree making any sale. This is not a dramatic or complicated strategy. It is simply understanding that the structure of what you hold in a taxable account determines how much taxable income that account generates each year, independent of your own decisions to buy or sell. The caution is that capital gains income, even at the 0% rate, still increases your adjusted gross income and combined income for Social Security taxation purposes. A large capital gain in a single year can make more of your Social Security taxable, even if the gain itself is not taxed. This interaction must be modeled before harvesting gains, not after. The fifth way retirees overpay is by not claiming the pension cost recovery exclusion when they have after-tax contributions in a pension or annuity. Many retirees who receive pension income made after-tax contributions to their pension plan during their working years. Government employees, teachers, firefighters, police officers, and many private sector workers fall into this category. When you contributed after-tax money to your pension, you already paid income tax on those dollars. When those dollars come back to you as pension payments, the IRS does not tax them again. Only the earnings and the employer contributions are taxable. The return of your own after-tax money is a recovery of your basis, and it is excluded from income. The IRS provides a calculation method called the simplified method in IRS Publication 575 that determines exactly what portion of each pension payment is a non-taxable return of your contributions and what portion is taxable income. Many retirees and even many tax preparers report the entire pension payment as taxable income because they were not aware of the cost recovery exclusion, or because they do not have the records to calculate it. Here's the dollar impact. If a retiree contributed $40,000 after tax over a career and now receives a monthly pension of $2,000, a portion of every payment is a return of that $40,000 and should be excluded from income. The precise calculation depends on the simplified method worksheet and the retiree's age at the start of payments, but the annual tax savings from properly applying the exclusion can be several hundred to several $1,000s, depending on the pension amount and the total after-tax contributions. Let me give you a real example of what this exclusion is worth. James is a retired police officer who received a pension from a city government. Over his 30-year career, he contributed a total of $36,000 in after-tax employee contributions to the pension plan. He retired at age 60 and began receiving a monthly pension of $1,800. Under the IRS simplified method, in Publication 575, James calculates his exclusion ratio. The method uses his age at the start of payments and his total after-tax investment in the plan. At age 60, the IRS table assigns a total of 310 expected monthly payments over his lifetime. His monthly exclusion is $36,000 divided by 310, which is approximately $116 per month. That amount is a return of his own after-tax contributions and is not taxable income. Over the first year, James should exclude approximately $1,392 from his pension income. If his tax preparer reports the entire $21,600 in annual pension as taxable, James is paying tax on $1,392 he was not supposed to owe tax on. At a 12% rate, that is about $167 per year. Over 20 years, that is $3,340. Overpaid on money he had already been taxed on once. And James is not an unusual case. Government workers, teachers, firefighters, and utility employees routinely made after-tax contributions to defined benefit plans throughout their careers. Many of them are receiving pensions right now and paying tax on the entire amount because the exclusion was never calculated. If you have a pension and you're not sure whether you made after-tax contributions, contact your former employer's human resources or pension administrator and ask specifically whether your pension plan received after-tax employee contributions and whether you have a cost basis. If you do, take that information to a tax professional who can calculate your exclusion ratio under the simplified method. Here's the villain in all 5 of these situations, and it is not the IRS. The IRS writes rules. Those rules contain deductions, exclusions, and strategies that are available to every qualifying taxpayer. The IRS does not enforce those benefits. It does not send letters saying, you forgot to claim your senior bonus deduction. It does not call to tell you that your pension payments include a non-taxable return of contributions. It does not follow up to ask whether you considered a QCD instead of a regular IRA withdrawal. The tax code is written so that the default result when you do nothing extra is that you pay the maximum amount the rules allow. Every benefit requires you to know it exists and take affirmative steps to claim it. The system is designed around what you know. Think about what this means at the population level. The IRS processes hundreds of millions of returns. Every return where a qualifying retiree fails to claim the senior bonus deduction is revenue the government keeps. Every return where a retiree over 70 takes a cash IRA withdrawal and donates it instead of using a QCD is money the government taxes that did not need to. Every return where medical expenses go untracked and unclaimed is a deduction the government never has to account for. There is no mechanism in the system that flags these missed benefits and corrects them automatically. If you overpay, you overpay. The IRS does not follow up. Your preparer may not know, may not specialize in retirees, or may not take the time. Dorothy in Ohio has been filing honest, accurate returns for more than 40 years. The IRS has no complaints about Dorothy. She's not making errors. She is simply not claiming everything she is entitled to because nobody told her the full picture. The solution is not expensive. It does not require exotic planning. It does not require a team of accountants. It requires knowing which 5 areas to check on your return every single year. Here is your action checklist. First, verify that your tax return correctly shows all 3 layers of your standard deduction if you are 65 or older, the base amount, the additional senior deduction, and the new $6,000 senior bonus deduction if your income is below the phase-out threshold of $75,000 single or $150,000 joint. Second, if you are 70 and a half or older and you give to charity and you have a traditional IRA, calculate whether directing your charitable giving through a QCD instead of a cash donation would eliminate federal income tax on the donated amount. Contact your IRA custodian and ask how to set up a QCD. Third, start tracking every unreimbursed medical expense in a simple spreadsheet beginning January 1st. Include Medicare premiums, supplement premiums, out-of-pocket costs for prescriptions and dental and vision, and transportation to appointments. At year-end, compare the total to 7.5% of your adjusted gross income and determine whether itemizing produces a lower tax bill than the standard deduction. Fourth, calculate your combined income before year-end and determine where you fall relative to the Social Security taxability thresholds. If you are near the $25,000 or $34,000 threshold for single filers, or the $32,000 or $44,000 threshold for married couples, there may be actions you can take before December 31st to reduce combined income and reduce the percentage of your Social Security that is taxable. Fifth, if you receive pension income, contact your former employer to determine whether you made any after-tax contributions to the pension plan during your career. If you did, obtain a record of your total contributions and bring it to a tax professional to calculate your cost recovery exclusion under the simplified method in IRS Publication 575. Let me address one more thing before the checklist, because it comes up constantly in the comments. People ask whether it is worth switching from a general tax preparer to one who specializes in retirees. The honest answer is that it depends on your situation. A general preparer who is competent will handle the basic mechanics of your return correctly: forms, withholding, standard deductions, RMDs, capital gains. But the 5 or 6 areas I described today are planning strategies, not compliance tasks. They require someone who knows to look for them, knows to ask the right questions, and has the expertise to calculate the benefit in your specific situation. A preparer who does not specialize in retirement tax planning may not know that your pension includes after-tax contributions, may not ask whether you give to charity from an IRA, may not calculate whether itemizing for medical expenses beats your standard deduction, may not flag that you missed the senior bonus deduction. This is not a criticism of general preparers. It is a description of specialization. A dentist and a cardiologist are both doctors. You would not ask a dentist to evaluate a heart condition even if the dentist is excellent at what they do. If your tax situation in retirement involves a pension with after-tax contributions, large charitable giving, significant medical expenses, a large traditional IRA with growing RMDs or investment portfolios with unrealized gains, a single consultation with a CPA who specializes in retirement tax planning may identify savings that pay for that consultation many times over. If you use free tax preparation programs like VITA or TCE, ask specifically whether the volunteer is familiar with pension cost recovery, qualified charitable distributions, and the new senior bonus deduction. These programs provide good service, but volunteer training varies. None of these actions require you to do anything aggressive. None of them require you to take a risk. Every one of them is a legitimate provision of the federal tax code that exists because Congress intended for qualifying retirees to use them. Let me give you one more practical observation before the final word. Most of the strategies in this video are not things you can do at tax time in April. They require decisions made during the year. The QCD must be completed by December 31st of the tax year. You cannot direct a QCD in January and count it for the prior year the way you can contribute to an IRA before the filing deadline. If you want to use a QCD for 2026, that decision needs to happen by December 31st of 2026. Medical expense tracking needs to happen throughout the year. If you decide in March to start tracking for a return you will file in April, you have missed 3 months of expenses you cannot reconstruct without receipts, capital gains. Harvesting at 0% needs to happen before December 31st and needs to consider your full year income picture. Selling a position in December without modeling whether the gain will push your combined income above the Social Security taxability threshold or above an IRMA tier can eliminate the benefit entirely. Roth conversions need to happen by December 31st, and the amount converted needs to be calibrated against the thresholds that matter for your situation. The window for acting on these strategies opens January 1st and closes December 31st. April 15th is just the deadline for reporting what happened. By the time you are sitting in front of your tax software or your preparer, most of the decisions that determine how much you owe are already locked in. One more thing that connects all 6 of these areas. Each one of them is more valuable in combination with the others than it is on its own. A retiree who uses a QCD reduces their AGI. Lower AGI means less of their Social Security is taxable. Lower AGI also means their combined income is lower, which may allow them to harvest capital gains at the 0% rate in the same year. Lower AGI means more of their medical expenses clear the 7.5% floor because the floor itself is smaller. Lower AGI means a higher chance of qualifying for the full senior bonus deduction before phase out. Every dollar you reduce from your AGI has a multiplier effect across all the systems that use AGI as their input. That is why the QCD and the Roth conversion and the capital gains harvesting are not three separate strategies. They are three inputs into the same income management system. Understanding how they interact is what separates a retiree who pays $10,000 a year in unnecessary taxes from a retiree with the same income who pays $2,000. The retirees who pay the least in taxes are not smarter than Dorothy. They are simply better informed earlier in the year. The money the IRS keeps when you miss these is not money you owed. It is money you are entitled to keep. This is Kevin Retires. If you learned something in this video that your tax software or your preparer has not explained, hit the like button right now and share this with any retiree who files their own taxes. Tell me in the comments, which of these 5 areas do you think most retirees are missing in your experience? I read every single one, and the most common situations become future videos. This is Kevin Retires.